Welcome to this month's real estate market update for September 2025. Whether you're a buyer or a seller or a real estate professional, this update is designed to give you the clarity and insight that you need to make the best decisions for yourself in this changing real estate market. So, for home buyers, we're going to cover what's happening in terms of affordability, interest rates, and inventory so you'll know if it's the right time for you to go ahead and make your move. For sellers, we're going to break down the latest pricing trends, average days on market, and what strategies are working right now to attract serious home buyers. And for our fellow real estate agents and professionals, we're going to take a look at the greatest opportunities in the market right now for uncovering hidden demand for positioning your clients for success in a shifting real estate environment. So the market is always moving, and knowledge is and always will be your biggest advantage. Let's go ahead and dive in. What we have is the market update report for September 2025. And what we're going to take a look at today is there has been a lot going on right now, obviously, in the market. And so I want to keep you up to speed. There are a lot of risks right now that there's potential for us going into a recession. We've been hearing this for the last couple of months. We're not there yet, according to Mark Zandi, and maybe this thing gets turned around. I believe it is, but he's taking a more pessimistic approach, trying to be practical for helping clients, buyers, and sellers be prepared as we head into the fall. But he is the chief economist for Moody's, and that is his perspective. Where he's coming from with this is the inflation does remain elevated. We're looking at the end of August, so a few weeks ago, we were looking at 2.9% for the core personal consumption expenditures price index. So our inflation is elevated, but that is expected to continue trending downward. According to Michael Strain, I think the worst is yet to come when it comes to tariff-driven inflation. I think over the next few months, we're going to see more and more evidence of the tariffs showing up in inflation. I disagree with this, but he is the director of economic policy studies for American Enterprise Institute. I think there is a certain political bend to that, but the market data just doesn't demonstrate that that is the case. So we're going to see. Unemployment is still holding steady. The unemployment rate increased to 4.2% in July, and that is expected to hold there as we move into late September, early fall. And job growth is stalling out. Now, we've had a revision of numbers from job growth, not just this year, but the past year, with several 100,000 jobs being removed over the last couple of years. So they're from the previous administration. So that has certainly affected the job growth as it relates to the economy. So how does that fit in with consumer confidence? People are concerned about a possible upcoming recession. Nearly 66% of Americans believe a recession is coming. 3 out of 4 Americans admit that the world news and our current events affect their financial decisions. So, what is going on in the news does affect people's purchasing decisions. So, an economic dip brings opportunity, but we do have to be careful. So, the Fed, as we're seeing right now, is in a tough spot, according to Daryl Fairweather, the chief economist for Redfin. There's an argument to be made with a weakening labor market that it's time to bring rates down. We've been calling for this for the last year and a half. Others point to rising inflation and say a rate cut is misguided. Again, this is highly politically motivated because the tariffs just simply have not panned out the way that these experts are saying that they should have, driving higher inflation, higher cost. That simply has not been the case. But according to Daryl Fairweather, the most likely scenario, the Fed will cut rates to stabilize the labor market, viewing any inflation from tariffs as temporary. So I agree with that. But if the assumption proves wrong, we could be looking at rate hikes again in 2026. If that is incorrect, if that is an incorrect assumption, then yes, that would happen. But again, the rates have remained elevated when, based on historical data, in previous administrations, those rates would have been cut several times, and they have remained elevated. So we'll continue. The stalling job market will make a cut likely, and again, most likely a 25% basis point cut. 91 50% odds or probability for that happening this month in September. It looks like that's going to happen this week. Um, so that is highly likely, which will impact affordability. Another thing to keep in mind, today's mortgage rates already have the anticipated September Fed rate cut priced in. This means that when the Fed officially announces the cut, which it just did, we shouldn't expect a significant corresponding drop in mortgage rates. So generally, what happens with the market is they anticipate the Fed cutting rates, and they build that in and they cut ahead of that announcement, which they've just done. Um, so what you're seeing right now in the market is a reflection of that anticipation. Mortgage rates declined after a weak jobs report. We're looking at the 30-year fixed rate mortgage, and you can see how it's been trending since May of last year, pushing up over 7% to 7.1%. And now we're trending just below 6.5%. Although we have been told for the last 2 years, we were told at the end of last year, we should expect interest rates in the mid to upper 5% range. And here we are still at 6.5%, trying to push the Fed to cut rates so that we can get affordability back down for home buyers. So what we're being told right now is we can expect, in addition to the Fed cutting rates, that 25 basis points in September, that we can expect two more rate cuts this year. Possibility of three, as you can see with the graph, but there's a 48% chance that we'll have two cuts, a 37% chance that we'll have three. But based on the Fed's activity over the last couple of years, I think even one rate cut would be welcome, but I think two would be fantastic because that would put us back in the range of sub 6% interest rates from an affordability standpoint. The 30-year fixed mortgage rate projections. So Q3 and Q4 of 2025, you can see where those averaged out at 6.6%, 6.5%. And then in Q1 and Q2 of 2026, they're anticipating 6.4%. As of today, we're actually seeing rates in the 6.25% because of that the federal funds rate cut. So we are in the 6.25 to 6.3% range. So another rate cut and possibly two could potentially put us again in that under 6% mortgage rate projection. So while there's always variation region to region, this is from Chief Economist for First American, Aditya Kushi. While there will be significant regional variation, the underlying fundamental conditions of the national housing market support a natural moderation of house prices rather than a sharp decline. In everyday speak for you and I, that just means that home prices are beginning to stall out. We're not seeing the rapid acceleration of home prices that we've seen over the last few years. Listing prices have already flattened. These are the monthly median listing prices, and we are seeing that these numbers hold true here in Central Virginia as well. They have flatlined, and they're actually beginning to recede a little bit. For the greater Lynchburg area, for the last several months, the average home price was at the 299, and it's actually pulled back to 289 over the last 30 days. And that's for Lynchburg City, but we're also taking into account you have Forest and other areas as well. So, but you can see that those, from a pricing standpoint, those have flattened out. And also, in a different type of graph, you can see where those prices, you can see there's resistance at that 450 mark, where when the median prices start to push to that 450, there's just not the demand to support that. And this is continuing back to the April of 2022. And that was at the tail end of COVID. So home price growth is the slowest that we've seen since the summer of 2023. This is the percentage change in sale prices year over year. We did have a negative home price where home prices fell in May of 2023. There was a 3-month, April, May, and June, where prices declined, but then they quickly picked back up and continued their appreciation. And again, this is year over year, but it has calmed. Historically, 3 to 4% appreciation year over year is pretty normal if you look back over the last 100 years. So right now we're in that 2% range, which is a bit low, but also that 6.5 to 7% appreciation year over year. That's just not sustainable for the real estate market because for the myriad of factors that go into that, such as consumer pricing and income and all of those things. So the housing market has cooled modestly this year, but the extent and persistence of rebalancing really varies across the country. And regionally, home buyers and sellers are likely to experience very different markets. So what this means and translates to, if you're in places like Florida, Texas, Nashville, New York, and also California, those markets do not reflect what I would consider middle America. When you have a big transient population, when you have a big influx of people from California moving to Texas and Florida, and you have a lot of people moving from the Northeast down to Nashville and again Florida, after a period of time, those markets become flooded with new buyers. And then after a couple of years, what we've seen is some of the folks just that they decide that's not what they want, and then they are rebalancing markets in different ways. So different regions have different flow, so to speak. So these are national trends. And so when we start looking at this by different regions, you can see the changes in home price growth and how they vary. So in the South Atlantic, you've got an appreciation, and that's where we are here in Central Virginia of 1.26%. East, South, Central for just over 4%. And then in Illinois, Ohio, Indiana, you've got 5.3%. And then the Middle Atlantic, which is Pennsylvania, New Jersey, and New York, 6.69%. And then New England, 5.4%. And then the market's relatively flat in the Oregon and Washington and California and your mountain states. So all of the growth is in the South, and a big driver of that is in the Nashville, Tennessee area. So the national average home prices did go up 2.94%. And again, historically, 3 to 4% is typical. So with the concerns of downturns in the economy, keep in mind that every downturn does end in recovery. It's very cyclical, and there's a natural variation to that. So when we look back for the last 50 years of market cycles and recoveries, you see decades of downturns where you have timelines of different major slowdowns in the housing market. So in the early 1980s, you had a major recession where mortgage rates were well over 18%, which froze buyer demand. In order to get financing, many of the buyers had to get the sellers to do seller financing just to put deals together. And then in 2008, we were here for that. We saw the great financial crisis where there was a massive drop in sales from the financial system just because there were so many erroneous things that were happening from the financial sector where we had no document stated income loans where they weren't verifying income. And basically, depending on if you had a decent credit score, you could tell the certain lenders how much money you were making and how much money you wanted to borrow, and they would write blank checks. So for those folks who were over leveraged and took advantage and over leveraged with these variable rate mortgages, they got burned big time when the market started to reset in 2008. And then obviously, we all know what happened in 2020 with COVID, where sales paused during the shutdowns and then came back faster than any time in modern history. And so right now we're having a natural downturn as a result of that, where you have high rates have slowed the demand down again. But again, that's a natural flow of the market that happens when you have a big run up. So this next chart looks at the median sales price of homes sold in the last 50 years. And again, what we're looking are patterns over time. And you can see that what we're seeing right now is consistent with what has historically happened. And these charts go back all the way to the 1963. So this isn't the first slowdown, and the sales always come back. So in the early 1980s, we had home sales drop by by 50%. In 2008, we had sales drop 51%. And during COVID, we had sales drop 27%. And currently, we're seeing a drop of 39%. In 1980, it took 4 years to come back. In 2008, it took 3 years to come back. That was quite interesting. And then post-COVID, it took 8 months to come back. And so we're looking right now to see how long it's going to take to come back. Everything that I'm seeing is that the market is beginning to recover now. And in the spring of 2026, we're going to see a very healthy, very strong market and an upswing. So downturns to recoveries, what does this look like? Again, when we look at the trends from the 80s, the 2008 crisis, during COVID, and then 2022 to present, the home price trend, and you can see in the last boxes, the home price trend and the mortgage rate trend, how they go together. So during the early 1980s, the home prices were up, the mortgage rates were up and down. During 2008, you had up and down prices, and you had mortgage rates coming down to try to offset that. And then during COVID, you had mortgage rates that dropped down and home prices came up. And currently, we have mortgage rates that had been trending upward that are finally starting to soften. But with those rates remaining up and elevated, we had the home prices have stalled out, and that's where we are today. So, what are the expectations? What can we expect in the market moving forward? According to Fannie Mae Home Price Index, these are the expectations for the second quarter of this year through Q4, the last quarter of 2029. And you can see the cumulative home price percentage change from now over the next 4 years. The most optimistic assessment is over the next 4 years, you can expect your home value to appreciate 27%. The most pessimistic is 6.7%, which is a little over 1% per year. Most likely is going to be in that 17%, it falls right in that 4% appreciation per year, which again, historically is very consistent with what has occurred over the last 100 years. So the recovery is expected to begin going into the new year. Again, I just said this. The existing home sales forecast as of August 25th of this year, you can see right now we're projected to finish the year right around 4 million units, which is right on track with what 2024 was, which was a very down market. With interest rates beginning to ease, there is quite a bit of demand in the market right now. And so the forecast for 2026 is the increase from 4 million homes being sold this year to 4.5 million being sold in 2026. So obviously there is demand there. So if this is for our real estate professionals, this is for our friends in the real estate community, this is the action plan for Central Virginia for the fall of 2025. The majority of so where's the opportunity? Well, the majority of builders right now are offering incentives. The percentage of builders that offer incentives per month hits a recent high. There's different reasons for this. My hot take on why builders are offering incentives and why there are great deals available for new construction is that we have seen lots of sellers who have put their home on the market. They wanted to get a certain price, and the market just was simply not supporting that, which was evident in the lack of showings and no offers coming to the table. And rather than bring the price down on those homes, the sellers simply took their homes off the market. And we've seen a lot of that this year. Conversely, and the reason for that is they were in a position where they didn't have to move. The thinking was, well, if I can get my price, I'll move. You may have seen that Zillow Make Me Move, where Zillow would throw a price out at you, or sometimes people will get these phone calls saying, well, what price would you be willing to sell your home? And sellers would make up a number that was just purely unrealistic. And when they didn't get that number on the market, rather than bring their home price into line with where the market actually was, they just decided to take their marbles and go home, so to speak. Now, on the flip side, home builders don't have that that luxury. They have inventory and they have fixed recurring costs that they have to move homes. They have to sell homes. So they are much more forward thinking than, Bill and Sue down the street who have thought about putting their home on the market, but only if they can get their price. Home builders have to sell their homes because those costs are going to keep coming every month from the bank for the loans and the financing they took out for these development projects that they're doing. And so, because of that, when they see the trends in the real estate market, they have positioned themselves to offer incentives for home buyers to make their homes more attractive. And we're seeing in cases where similar new construction homes are selling for $20,000 less than similar resale homes. So you can get a brand new construction home for, imagine, 20 grand less than a similar home that somebody has been living there for the last 5 or 10 years. Builders also continue to cut prices, and this is not just individual single family homes, but also with townhomes. Builders are continuing to cut their prices, and you can see these percentages that if their homes aren't moving, their option that they have are fairly limited. If it's not moving, they've got to get the price down. So either they're offering additional incentives to buy down rates to make the affordability more attractive to home buyers, or simply just getting the price down to be able to elevate their homes above the residential resale homes that they're competing with. So all this to say, the reason why this is important is most agents have a pretty good understanding of what's happening around them. They pick up bits and pieces of what's going on in the market, maybe on Bloomberg or different real estate sites. Generally, they know in the MLS what's happening. Good agents, they understand what's happening, and great agents are able to explain what's happening, and not in a convoluted, um, complicated way. But in my opinion, we should be able to explain things that we truly understand at a fifth grade level. So if you have a fifth grader and you can explain what's happening in the real estate market to them, why things are happening, those agents have a great understanding. So that's where we want to be positioned. So if you are a home buyer or home seller, the real estate agent that you choose to work with should be able to explain what's happening in the market right now in a very clear, understandable way. If they don't, maybe they don't understand the market. Likewise, as a real estate professional, we've got a great opportunity to be able to explain and help our clients understand where the market is heading, why, and what they can do to position themselves to be successful in this changing market. So if you have any questions or if there's anything we can be of help with, please let us know. That is what we are here for. I appreciate you taking the time to check us out here. And as always, we are so appreciative to you and your referrals. And that is because you are the heart of our business. So look forward to connecting with you guys soon and make it a great one. And we'll talk to you again. See ya.